Hello everyone. As you might be knowing how the show Shark Tank has become a heated topic in conversation among business enthusiasts these days. But it's very common to see startups which are making losses year on year and are not at all profitable but still have a very high valuation. Now one might wonder how. But don't worry, because we've got you all covered. Now let us understand how this whole process of valuation of a startup works along with its manipulation. Let's dive into it. So, what does valuation of a startup essentially mean? Valuation of a startup is basically quantifying the worth of a company in monetary terms. When the founders of a startup approach investors for investment, investors pour in their funds in the startup in exchange for a part of the equity in the company. Now, this can be done in several ways. Let's understand each of them one by one for a clear understanding. So, the first method is revenue multiple method. Now, as the name suggests, the valuation of the startup is based on the revenue earned by it. Now, this is a widely used method, especially because in the initial phase, the startups are not very profitable. So, they're left only with the revenue to get the valuation done. Now, this method can only be adopted by startups which have a decent and a stable revenue. For this, ARR is taken into consideration, that is, the annual run rate, which signifies the annual revenue earned by a startup. Multiples from 2x to 5x are applied to this ARR to get a valuation based on multiplicity of factors such as the growth, idea, prototype, etc. The better these factors, the greater the number of multiple. For example, company X has an ARR of 5 lakh rupees, and based on these factors, it gave itself a multiple of 3x. So its valuation will be 5 into 3, that is 15 lakh rupees. A second method is comparison method. Under this, a startup compares itself to other company and firm of the same industry based on various parameters to get an idea of its valuation. For example, let's say a startup ABC Limited is incorporated as a fintech company. This startup will go about comparing itself to other established fintech companies like Paytm, Google Pay, PhonePe, etc. Now, let's say Google Pay has a valuation of about $200 million and an active user of about 1 crore. Now, ABC Limited has 20 lakh people as its active users, that is 20% that of Google Pay. And so its valuation would be 20% that of Google Pay, which is 20% of $200 million, that is $40 million. The third method is the Berkus Method. This Berkus Method aims at valuing a startup based on a detailed assessment of 5 key factors, that is, the prototype, the idea, the team, the strategic relationships, and the revenue. A detailed assessment is carried out to ascertain a certain monetary value for all these 5 key success factors. The startup's valuation is the summation of such monetary values. This approach generally allocates up to $0.5 million per factor to get a maximum valuation of $2.5 million. The last method is the discounted cash flow method. This method aims on projecting the startup's future free cash flow to the firm, that is FCFF. A rate of return on investment called the discount rate is then ascertained keeping in mind the risk associated. Now, since the startup is a new company with high risk associated with it, the higher the risk, the higher the discount rate. The free cash flow to the firm are then discounted to the present value, and based on this present value, stakes are offered to the investors in the company. Now, after understanding the concept of startup valuation, let us see how these businesses and startups manipulate different matrices in order to get a higher valuation. These days, it's very common to see businesses generate fake and irregular expenses to reduce their tax liability. But startups do the exact opposite. They show higher revenue. This is because their valuation is done in multiple of their revenue. So the higher the revenue, the higher the valuation, and the more ease in raising funds. Now one might wonder, how do these startups manipulate their revenue streams and matrices? Now one way startups use to inflate their revenue is by recognizing revenue prematurely. This happens when they recognize revenue from a transaction which has not been completed yet. Another way they can inflate the revenue is by recognizing revenue that has not been collected yet. It is also known as accounts receivable, which is the money owed to the company by its customers for products and services that have been delivered but not yet paid for. Now, startups can show this money as revenue to make their financials look better, but it does not necessarily mean that they've actually made this money. As for the matrices, the most common way to manipulate these is by inflating a particular campaign. Now, let us try to understand this with the help of an example. Let's say a company ran a Google ad campaign, but it altered the data points to make it look like the campaign was more successful than it actually was. Now, this can be done by altering the number of views or clicks a particular campaign received by using bots or other fraudulent methods. Or it might focus on the number of likes or shares a social media post received rather than the number of conversions generated by that campaign. Now, this is called focusing on vanity matrices. Some other ways to do the same are: first, inflating cash flows. Now, this can be done by routing the transaction through a personal bank account to gain credibility for taking bank loans. Second, improperly writing off of assets. It includes writing off of bad debts which never even occurred in the first place. Third, distorting the debt matrices to hide liquidity problems. It involves doing away with certain debts and doing off the balance sheet financing. Detecting these frauds and matrix manipulation can be a complex task, but here are a few ways in which you can identify such potential threats. Number 1, look for unusual trends. If a startup's revenue spikes or drops suddenly without any apparent explanation, it could be a sign of a fraudulent activity. Number 2, third-party transaction. If the number of third-party transactions is increasingly high, it is always advisable to have an independent audit of the firm's financial statements. Third, irregular compensation scheme, too many cash transactions, and an unexpected increase in the capital expenditure might also be some indicators. Hence, by being vigilant and conducting thorough checks, one can identify such issues and take steps to address them before they turn into major problems. We hope you found this video helpful and informative. If you liked our content, please consider subscribing to the channel and turning on the notification bell so that you never miss an update. If you have any queries, leave them down below and we'll be happy to respond. If you found this video valuable, please give it a big thumbs up and share it with your friends. And also, don't forget to check out our other social media handles for more of such content. Thank you for watching and we'll see you in the next video.
Fuck